Welcome back to Organized, the Business Law Breakdown. I'm Professor Seth C. Oranburg, and in this episode, we'll dive into the first of our core business entity choices, the general partnership, in our continuation of our series on organizational decisions. We're building on the framework we introduced last time, and you might be surprised to learn just how easy it is to form a general partnership. In fact, they can even emerge by accident without any formal intent or any paperwork. But while these business relationships offer simplicity and flexibility, they also carry significant risks that can catch unsuspecting participants off guard. So let's walk through what general partnerships truly are, how they operate, and why they're both appealing and perilous. And we'll analyze them through our 7-issue framework: formation, liability, control, financial rights, continuity, liquidity, and mergers. Under most states, especially those based on the Revised Uniform Partnership Act, or RUPA, a general partnership is defined as an association of two or more persons to carry on, as co-owners, a business for profit. And that's it. No elaborate ceremonies, no mandatory filings, no fees to the state. If two people collaborate on a venture and start sharing profits, they may have inadvertently created a legal partnership. This ease of formation is both a major strength for quick and formal collaborations and a potential danger, as it can impose heavy obligations when there's no explicit agreement. To illustrate, imagine two friends deciding to flip houses together. They pool resources, buy a property, renovate it, sell it, and split the proceeds. Even without a signed document, courts would probably deem this a partnership based on their conduct with the intent to profit. That's why it's important to understand the implications before jumping into this kind of business. So let's explore why it matters with our 7-issue framework. That'll help us decide whether a general partnership is the right fit for a given scenario. So we'll highlight its strengths for low-stakes, trust-based ventures, and its weaknesses for anything with real financial or legal exposure. So we'll begin, as always, with formation. Formation for a general partnership, again, couldn't be simpler. It can be informal. It could be a handshake. There's absolutely no need to file anything with the state to create one. A general partnership can arise purely by default, based solely on the parties' conduct and shared intent. For instance, if you and a friend start selling handmade crafts at a local market and you split the earnings, or even if you co-manage a side gig like tutoring services and divide the profits, you're probably already partners under the law. Under RUPA Section 202, the key indicators include sharing profits, which creates a presumption of a partnership, joint control over business decisions, and co-ownership of assets. That means general partners are... This means general partnerships are incredibly cheap and easy to form. There's no registration fees, no articles of organization, no bureaucratic hurdles. It's ideal for bootstrapped, low-overhead ideas like a pop-up food stand or a freelance consulting duo. But this very informality is its double-edged sword. People can stumble into partnerships without realizing it, and it can lead to unintended legal ties and obligations. For example, if one partner signs a contract or incurs debt, the other could be on the hook personally, meaning courts can look at factors like whether a partner has bound the partnership, and the other partner's own personal property could be at stake if that partnership fails to honor its contractual obligations or has some tort liability. Courts will look at factors like shared bank accounts, joint business names, or even casual agreements to determine if a partnership exists, and when it does, both parties are liable for the business's debts. A key case was Meinhard v. Salmon, which was actually a joint venture, but it was treated like a partnership. It's an older case from 1928 where a real estate venture was ruled a partnership despite no formal agreement. And it highlights the danger. Without a written partnership agreement to clarify terms, you're at the mercy of state default rules, which may not align with expectations of entrepreneurs. Second, let's talk about liability. One of the most critical issues and a major red flag for general partnerships is unlimited liability. So here's the catch. General partners face unlimited personal liability for the debts and obligations of the business. This isn't just for their own actions. They're liable for the actions of every partner, so long as the partner is acting within the scope of the partnership. This is known as joint and several liability, and you can see it codified in RUPA Section 306. And it means that creditors can pursue any partner individually for the full amount owed, even if that partner didn't cause the issue. For example, if one partner negligently causes an accident during business operations, say while delivering goods, they break someone's property, the injured party could sue all the partners personally, putting their homes, their savings, and their other assets at risk. So this is a low-cost, high-risk structure, starkly contrasting with some of the limited liability entities we'll discuss later, like corporations or LLCs, where limited liability means owners' personal assets are generally shielded. We talk about piercing the corporate veil in some of my other series because there are some limits to limited liability. But for now, general partnerships are really only suitable for low-risk, trust-heavy ventures among close allies because you really are putting your personal assets at risk based on your partner's actions. This will actually relate to some concepts we'll talk about later, like transferability, because you have to trust your partners. It's harder to transfer shares because most partners would not want that to happen without their consent. If disputes arise, partners can seek contribution from each other afterwards, but it's small comfort when your personal finances are exposed. So I advise clients that if liability is a concern, and frankly it almost always is, consider alternatives or at least have a strong agreement limiting scopes of partnership authority. Let's shift to control. General partnerships are remarkably egalitarian by default. Look at RUPA Section 401. It says that every partner has equal rights in managing the business. And that's true regardless of how much capital, time, or effort they contribute. So decisions in the ordinary course of business, like buying supplies or hiring help, those can typically be made by a simple majority vote, or if they really are ordinary course matters, any partner can bind the business in them. The flat governance model can foster true collaboration, and it allows for quick decision-making in small, harmonious groups, much like a team where everyone's voice matters equally. Now, extraordinary matters, such as dissolving the partnership, admitting new members, or amending the partnership agreement, those typically require unanimous consent. You can see that in RUPA Section 401J. This protects against radical changes, but can also lead to deadlock and frustration, because if the partners disagree and can't come to a decision, then the business might actually have to dissolve. It may come as a surprise that businesses function this way, because if one partner invests $100,000 and another has nothing but ideas, they still share equal voting rights by default. And since that's not how corporations work, this might be surprising. And again, that's why a partnership agreement is vital. A partnership agreement can customize the voting weights, or it could simply state out loud that it's one person, one vote, and everyone has a paper that they can read to understand it. The partnership agreement could also tie voting rights to their contributions or assign roles. But without a partnership agreement, the default is egalitarian, which works great when there's perfect harmony and not so great in real life. Next, let's talk about financial rights. By default, profits and losses are split equally among the partners. Again, that's irrespective of their individual contributions. Another nod to partnerships' egalitarian roots. If one partner invests $1 million and the other invests $1,000, they still divide the profits 50-50, unless specified otherwise. This can feel fair in balanced teams, but could certainly breed resentment in uneven ones. And again, it might be surprising because two parties who enter into business together and who never form an agreement have actually formed a partnership subject to default rules, including this default 50-50 split. A partnership agreement, once again, can override this default. It could allocate profits based on sweat equity or initial investments. But a lot of partnerships that are formed accidentally don't have agreements either. And by the time you have something sophisticated enough to merit a partnership agreement, you might be thinking about forms that also protect you from unlimited liability. And without these agreements, surprises abound. Losses also flow through, so you might be personally liable for more losses than you expected. And for better or for worse, these losses show up on the partner's personal income tax statement. The financial rights demand explicit planning to align with realities, or disputes can erupt over what's a fair share. But again, the default is equal. Every partner gets an equal share by default, different than in corporations. Our next element is continuity. Continuity of existence is an area where the general partnerships show fragility. Traditionally, under the older Partnership Act of 1914, the Uniform Partnership Act, or UPA, partnerships actually dissolved when a partner withdrew, died, or went bankrupt. The idea was that the partnership was merely an aggregate of its people. It had no independent life, and it wouldn't exist if those exact group of people were not continuing on the business. Now, that's changed in many states who've adopted RUPA, the Revised Uniform Partnership Act, which in Section 801 says that partnerships should be treated as entities, which allows them to survive after a partner's disassociation. The remaining partners can buy out the departing one's interest and continue operations, providing more stability in these jurisdictions. But that said, continuity still hinges heavily on state law variations and on the partnership agreement, again, if one exists. Without clear terms, a partner's exit could force a full winding up, distributing assets and potentially ending the business prematurely. This contrasts sharply with corporations' perpetual existence. But it does suit temporary ventures like joint projects. Again, check your jurisdiction. Some states cling to older rules, making the partnership even more precarious. Let's talk about liquidity. Liquidity means the ability to exit by selling one's interests, one's shares in the terms of a corporation, or units in the terms of an LLC, or interests in the term of a partnership. Liquidity is very low in general partnerships. You can't easily transfer governance to outsiders. In fact, under RUPA Section 503, in order to sell your governance rights, your ability to participate as a manager of the partnership, you need unanimous consent from all the partners. Now, this makes sense given the personal trust and liability involved. Partners choose each other carefully because they can all bind the business. One bad apple can bind everyone to poor decisions and create unlimited personal liability for everyone. Financial interests like profit shares can sometimes be assigned, but the assignee doesn't become a full partner. They might get economic benefits without voting or management rights. Partnerships aren't designed to be liquid. They're designed to be illiquid. They're designed for closely held, tight-knit groups where transfers are rare and very deliberate. If liquidity is important or key, say you want to attract investors who are going to try to exit, choose another form. This illiquidity protects the group, but it can trap unhappy partners, leading to buyout disputes or forced dissolutions. Finally, we'll talk about mergers. General partnerships can merge with other partnerships or convert to different entity types, but it typically requires unanimous consent from all the partners, and that's found in RUPA Section 905. There's no streamlined, off-the-shelf process like in corporate law. There's no statutory merger with minority protections and appraisal rights like you'll find in Delaware. Instead, you have to have a lawyer draft a merger agreement, and you're going to want to work with an accountant who will help you figure out how to transfer assets and liabilities. And you might have to dissolve the old entity. It's a complicated process. And again, it's not what these are designed for. We're not really building partnerships for sale. We're building them to be held within a tight-knit group. The informality of partnerships suits small-scale combinations, but it gets very messy for larger ones. And you're going to want legal help to avoid tax pitfalls or overlooked obligations. Compared to corporations' formal merger statutes or LLCs' flexible conversions, partnerships really lag in ease, or at least ease in mergers. Again, easy to form, but you have all these costs. They're ideal if you're building to stay independent, but they're risky if growth via acquisition is the goal. So always consider if merging is on the horizon, a more structured form might save headaches. So let's summarize what we learned about general partnerships through our framework. They're incredibly easy to form, sometimes accidentally. There's no filings that are needed, but that simplicity hides dangers like unlimited joint and several liability, where one partner's mistake can bankrupt everyone. Control is egalitarian, like one partner, one vote, at least from a default. That fosters collaboration, but it risks deadlock, especially in two-person partnerships. Financial rights default to equal as well. Equal rights to profits, equal responsibilities for losses. That's fair for balanced teams, but it can surprise when there's an imbalance in contributions. Continuity has been improved under RUPA, but it still depends on agreements to avoid dissolution upon exits. Liquidity is very low, with transfers needing full consent to protect the group's trust. And mergers, while possible, demand unanimity and custom planning. There aren't the efficiencies built into the merger process like corporate law has. So general partnerships shine for small, low-risk ventures among trusted allies, like a short-term consulting project between old friends, or co-authoring a book. And in cases where flexibility trumps protection, they can be useful. In cases where flexibility trumps protection, general partnerships can be useful, but they can be hazardous for serious businesses with significant debt, employees, or growth ambitions, unless they're fortified by a strong partnership agreement. So when might someone deliberately choose this form? Well, there are some tax advantages in doing a joint venture or partnership, and formalities might feel burdensome. But there are other forms that can accomplish these tax advantages now. So we warn clients, without an agreement, default rules can lead to nasty surprises. And if you're going through the trouble of putting together a partnership agreement, maybe we want to select a more formal path that also provides liability benefits. Disputes can arise easily without a partnership agreement because there can be surprises around profits, losses, or exits, and those cases often end up in court. So we'd rarely elect the partnership form proactively for clients with significant risk. We'd steer them toward limited liability vehicles, which we'll explore next. Thanks for listening to Organize, the Business Law Breakdown. I'm Professor Seth C. Oranburg, and in our next episode, we'll talk about limited partnerships.